on yourself. Most folks afraid to fail, but you can't level up in life without a couple of L's. Life lessons, or should I say blessings? If you can't get it out the mud, then you can't manifest it. Bet on yourself.
All right, guys, we're back. This is
The Entrepreneur Network
with Jeremy Winters, and that's right, Akeem is still out of the country somewhere eating something that's going to give him diarrhea, but that's okay because I'm holding down the fort. And today we've got a special guest, Andy Gobin of New Star Mortgage, and I'm excited to have you again today. Everybody, round of applause for my man Andy, y'all. All right, so this is crazy because a lot of the people that come on the show, I've met them probably in the last week or two, or you know, something like that. But I've met you a while ago.
Yeah.
One of my good buddies is you're kin to him. I've been to your house. You know, we've hung out. You know, I think I've beat you several times on your pool table.
My pool table.
Yeah,
correct.
man. And you know, I'm a pretty good pool shark. And if you know me for real, you know that's a lie. I was just having good luck that day.
Good luck, that's it.
So that's gonna be my claim to fame that I beat you at pool.
Hey, that
So,
works.
Yeah. So tell everybody about yourself and exactly where you're from and name of your company and what it is that you do. We'll start there.
Okay. All right. Well, as Jeremy said, I'm Andy Gobin, senior loan officer, mortgage broker at New Star Mortgage. I've been doing this for about maybe 20 years.
Okay.
Started off at a smaller mortgage company, and eventually we branched out and kind of did our own thing.
Okay.
Or whatnot. We've been through a lot of pitfalls, you know, with the financial collapse, the mortgage meltdown, all of the good stuff. So it's been a challenge, you know, just kind of staying relevant, you know, and also just staying in the business, you know, because a lot of people that were in it with me back in before meltdown actually got out of the business, you know.
Okay.
So it's had its challenges, but hey, we're still here.
Yeah. So let me ask you this. Where are you from originally for the audience?
Yeah, born and raised right here in Atlanta, Georgia.
Okay.
Yep.
So here in Atlanta, and then you get into the mortgage industry. Where did you start? Was anybody in your family doing it, or is it a situation where you just stepped out and said, "This is what I want to do"?
Yeah, you know, it's funny. So, you know, you go to high school and you go to college. You know, you get out of college, and the idea is that you're going to get your dream job, go out, make a boatload of money. Right. Get out of college, you know, during that time, you know, a lot of companies would not hire me just with no experience, you know, come out in the financial background or whatnot, but you can't get a job without experience.
Right.
So I tried a few different jobs, you know, whatnot. I ended up going to a mortgage company. You know,
Okay.
My wife was an employee at the mortgage company at the time, and that company, her mom and her partner owned the largest minority-owned lending company in the Southeast.
Okay.
So
That helps.
Yeah, it helped. Yep. So started out, went through the training. I didn't know anything about credit. Didn't know anything about income, tax returns, W-2s, any of that
So
stuff.
let me ask you this: what was your major in college?
Financial. Yep.
Okay, so you did have a financial background, you just didn't have any experience.
Just didn't have any experience. Yep.
Got it. Understood.
I applied with all the big guys, Bank of America. At the time, this bank was called SunTrust. Wachovia, and then it turned into SunTrust or whatnot. But just could not get a job anywhere.
It's like one of those things where they ask you, they want to see a form of ID to get ID. I never understood that.
The exact
Like,
same
you want
thing.
an ID? Give us a piece of ID.
Yeah. the
So
exact
in
same
this
thing.
particular case, you want to work here, like show us, like, I just graduated. But
Yep.
no, that's I appreciate that. So you applying at all these other companies and they're shutting you down.
Shutting me down. So anyway, fast forward, talks to a guy named Tony Bright, right? And he's over the loan officer or the sale production of this particular company. And my mother-in-law was in the underwriting department. So Tony's job was to bring in the business. My mother-in-law's job was to get the business out, get it approved, closed, and get it funded.
Got it.
So my wife didn't really think it was going to be a good idea because, you know, you're starting off as a 100% commission type job, you know. No leads are supplied. You just go out there, you get a business card, and you go out there and say, hey, go for what you know.
Right.
You know? One thing about it, you know, I tell a lot of people, you don't know what you don't know, right? So getting out of college, you know, my credit scores were like 400-some credit scores, no money in the bank. I was working a few part-time jobs. So here I am trying to figure out my way, you know, in this world, right?
Right.
So, you know, you go through the training, you learn about how to, you know, read credit reports, how to calculate income on paycheck stubs, how to read W-2s, tax returns, you name it, right? Now you have to figure out how to get to business. So now you have the knowledge, you're still 100% commission. So it's not like you have a base salary or any kind of draw or anything like that. You're 100% commission. So now In the training, they tell you to kind of form partnership with real estate agents, right? So you go to Central 21, you go to Remax, you go to Coldwell Banker, you go to Keller Williams. You say, hey, my name is Andy Gobin. I'm a loan officer. I can get your customers approved. But there again, right back at square one, let's say if you're a real estate agent, you've been in the business for anywhere more than 90 days, you're not trusting a new loan officer with your book of business.
Correct.
Because this is how you pay your bills. This is how you pay your car note.
You want to make sure you go with somebody that's proven that if I put my candidate in your hands, that you're going to get them to the finish line.
You're going to get them to the finish line.
Understood.
So there again, I'm back at square one because now people won't work with you without experience. You're a new guy. You're 20-some years old. It's just not going to happen. Yeah. So now, mind you, this was before like the social media phase. This was before like MySpace. I mean, Facebook wasn't even around then, right? When I got into business. So
you're telling your age, bro. If Facebook wasn't around, it's called.
Cool. These grades probably doing it anyway. But it's one of those things where like you got to figure out a way.
Right.
Okay. So I went old school with it. I ended up making some flyers with a stop sign on it. And these flyers, I didn't have a whole lot of money, so I took 8.5 by 11, right? And I cut it in half so I can get 2 flyers out of 1 page, okay? And I had a stop sign on it because I saw another guy doing it, and he was doing pretty good. I don't even know where that guy was from. I just happened to see it somewhere.
Yeah.
And the had a stop sign on it, red with white letters with a stop, like a real stop sign on it. Right. And it just said, stop paying rent, own a home.
Oh.
I printed these flyers up, and every day I went to apartment complexes, and I put these flyers on cars. I put them on apartment doors. I would go to Walmart parking lots. If I knew there was a warehouse where employees with jobs were there, I would go there, put out cars, put out the flyers on the cars. I would do that everywhere I could go.
Yeah.
Unless security, the maintenance man, whoever, unless they tell me no soliciting or just kick me out, I did that every day.
So there's a lesson here. And listen, everybody, you said something that was very important, right? I'm going to, and I was telling our producer this the other day, I'm going to trust the person that's got the scabs on their knuckles, the arrows in their back,
right,
and have been around the block a few times because they know how it's done. And what I mean by that is, you said you made this flyer with a stop sign because you saw somebody else do it and he was doing great.
Right.
So, like, why reinvent the wheel?
Exactly.
Like, he's figured it out. This works. So this is what I'm going to do. People, stop trying to invent the wheel, man. There's people that already figured it out. But back to your story, you figured it out, and you putting these flyers everywhere.
Yep, putting these flyers everywhere. So I would get back to my car, and I'm telling my age again, I had a pager, which we probably about pagers back in the day, right? So on the card, I had my pagers, didn't have a cell phone. So I would get all these pages, when I got back to the office, I had to return all those phone calls, right? So I'm talking to all these people. I'm up at late at night talking to people, getting their name, date of birth, socials, employment information. Start pulling credit. Everybody's credit is shot, right? Everybody's credit is shot. So I got a little discouraged, but nonetheless, I was getting a lot of people because nobody was bringing it directly to the apartments like that.
Right.
So mind you, back then there's not social media where you can just go on a page and make a video and get 10 or 15 100 views, just like that.
Yeah.
Nobody was doing that.
Yeah, but the beauty of that too is if I see a flyer and on this flyer is the answer to my prayers, on this flyer is a solution to a problem that I have, I'm going to call because this is a problem that I have. And the beauty of that is they're not looking at you, the inexperienced loan officer. They're looking at my problem on paper can be solved by this guy.
Exactly. Yeah.
So, hell, I know the person sitting next to me on the couch can't help me. The least I can do is page this guy.
Page this guy. So let's see what happens.
Yeah, let's see what happens. So it makes perfect sense, man.
Yep. So, I'm working with these people. All the credits are shot. So I don't have a lot of business. So I have time to go through these credit reports. Hey, call them back. Hey, you need to do this, do that. Sometimes they'll come into the office. I'll sit down with them and actually go over the credit report. Pay this off. Look at this repo. Work on this child support. Pay off this tax lien, and we'll get you approved. A lot of people just needed that direction, right?
Right.
So a lot of people did it. They did what they needed to do. Came back to me, pulled credit. Next thing you know, I got an approved loan.
Yeah.
So now I got a lot of approved buyers. So now I would go back to those same real estate agents and say, hey, I have buyers of my own. Can we share leads? Can we exchange business if I maybe give you a deal instead of you sending the loan officer deal?
Yeah, because now you're providing value.
Now I'm providing value.
Yeah.
So I went to those same agents, Remax, Coldwell Banker, Central 21, with these buyers, with different realtors, already approved, ready to go. They go out, find them a house, deal closes, they're happy. So now they're sending me business.
Right.
Right? And now other realtors are seeing these guys closing, and now they're saying, "Hey, how are you closing? You know,
where are you getting these people from?
What's going on? Hey, I'm using my guy Andy over here. You know, I'm using my guy Andy." Next thing you know, the other realtors are calling me. Now I'm still putting out flyers, you know, every day, still doing what I'm doing, right? And then it gets to a point to where I'm not putting out any flyers because I have so many realtors now that know my name, they know I can close, and now they're actually sending me business.
Right.
And I'm just sitting at the desk just getting the leads, you know, coming in.
Right, but then not only that, you're probably getting higher quality leads coming from the realtor.
Higher quality leads coming from the realtor. Yep.
Yep.
And even if the leads were not quality, they knew that, hey, I was a younger guy and that I would, you know, take time to kind of go through
right.
every person that calls.
You nurture them.
I nurture them.
To get them there.
Yep. And even to this day, that's something that I advertise and I market because a lot of companies, I mean, if you apply to, let's say, Wells Fargo or some of the big guys and you get denied for a loan, they email you or mail you a denial letter. And that's it. You don't really know why you got denied, or even if they do tell you why you got denied, most likely you don't really understand it, right? So even to this day, I still tell people what they need to do to get approved. And that's part of my business and what really helps me out a whole lot because somebody sat down with me, went over my credit report, and said, hey, you need to pay this off and you'll be good to go.
Yeah.
One thing that I had on my credit was a department store card, right? And the minimal payment on this card might have been like $10 or $15. Right. I didn't pay it. Now, did I have $10 or $15 to pay this bill? Yeah, I had the money, but I didn't think it was a big deal. I would wait till that bill got up to about $50 or $60 to where it was worthwhile my time to go to the store to pay the bill. Didn't know that each month that was dinging my credit for a 30-day late each month. Yep. Never knew it was having that kind of impact.
And what it's doing is it's showing a history of someone that doesn't take care of their business.
Yep.
But the whole time, you know it's out there, but you're not realizing it's impacted you in the way that it's impacted you.
Not even realize it's impacted
you. Yeah. So that's key. And here's the thing: how did you get to that place? So can I assume that this was during college? Because
those credit cards. Yeah, that was during college.
Okay.
You got student loans. You know, they come out of deferment. You don't know they're out of deferment, and you get something. I mean, and who knows that? You know, they could send bills to like your old college dorm, your apartment from college. You put it back in deferment, then it comes out again. The minute that loan comes out of deferment, a payment is due.
Yep.
And if you don't make that payment, a 30-day late.
Yeah.
Just like that. So most people coming out of college, you know, your credit is shot. You know, right now we are in a time where more people are financial, you know, literate. But back then, I mean, the information just was not there.
Got it.
Right now, the information is at your fingertips if you want it or you know what to look for. You know, when we were growing up, all we had was encyclopedias.
Yeah.
You know, I tell a lot of young people, man, you got YouTube, like everything you need is in your pocket. You just got to go to the right spot.
I am a 13-time graduate from YouTube University. I keep telling people.
Yeah, man.
Like, you know, I'm currently enrolled right now.
I fix refrigerators and everything that go on in my house. I go to YouTube first and see how tough it looks.
And let me say this. Like, so many times in the black community, and I'll speak for my family, and you can just tell me if I'm accurate in this. We are always told to run as far away from credit as you can.
Yep.
You don't need credit cards. It's a trap. Don't do that. But really what we didn't know is that we were just afraid of it because we didn't understand it. We didn't understand it. And I wish I had known that back then, what I knew now, because, you know, I could have led so many people down a different path.
Oh, man, it's amazing. It's amazing. Yep. So it's one of those things, man. You live and you learn, and you just try to help people, you know, as you go forward. Yeah. You know, with me, once I got my volume to a point where I didn't have to go out, you know, and put out flyers, at that point, you know, I went to subdivisions, you know, to be the preferred lender. That didn't really work out too well because they want to work with a lot of the larger companies and whatnot. Right. So I went to them as a backup lender. So, hey, well, if your preferred guys can't get these people approved, send me your turn downs and let me work with those guys too. Right. And before you know it, I was a backup lender to a lot of the subdivisions for new construction.
And again, you're willing to put in the time. To help the lender. I mean, help the
realtor get to where they need to be.
Yeah, to get them to where they want to get to. Yep. So I get it.
Yep. And before long, man, I think at that company, they were the largest minority direct lender in the Southeast, licensed in, I want to say, maybe 5 or 6 states. Mm-hmm. And within about the first 12 months of me starting, I became the top producer at that company.
Got it.
So it was pretty good, man. And it was back in the heyday where, you know, you could get a lot of people approved, you know. But it was still tough because it was really, really competitive. It was a lot of people in the business. Even within the company, it was a lot of competition. We had awards that we would do for the top producer each month. And my goal was really to get those awards at the end of the month, because once you make a lot, a certain amount of money, at a certain point, it gets not about the money.
Right.
It's about other stuff,
Right.
It's about, sometimes it's competition. Sometimes it's about, establishing yourself for the future. But for me, it was just about competing.
Understood.
I just want to be in that top, percentage each and every month.
So let me ask you this. At what point do you say, all right, it's time for me to do my own thing?
Well, what happened, the market actually told me to do that. So what happens, during the mortgage meltdown, we fast forward that company I was with, First Service Mortgage, it was doing great, right? Fast forward to the mortgage meltdown, the financial collapse. Mortgage companies get hit with what we call buybacks, okay? So that means that if we give a loan to somebody, they go into default, and let's say if it's an FHA loan, if FHA audits that file and they says, okay, this person went into an early default, they try to look and see if it's anything that you could have done differently when you approve that loan. A lot of times they'll find something to hang that lender on. Right. Now that lender has to buy that loan back from the federal government.
So what you're telling me is they will go through the loan with a fine-tooth comb and find a weak spot and say, this loan defaulted because you didn't verify this,
or you missed that, or you should have done
so
something.
So now you're responsible to buy back this loan.
You buy back that loan.
I didn't even know that was a thing.
That's okay. A thing, yep. And what happens for a small or medium-sized mortgage company, it'll tank you.
Yeah.
I mean, it'll tank you.
Yeah.
Yeah. So what happened, the two partners, they couldn't really agree on which way to go with the industry. There was a lot of turmoil. I mean, you had really large companies that were going belly up, I can't even name the amount of companies that actually went under during that time. So one of the partners decided to try to keep the company. Another partner wanted to branch out and do something smaller. And I'm kind of torn in the middle, because at this point, my personal volume is probably sustaining, probably 40% of the company maybe.
Okay.
Yeah. So, I was hitting numbers, man. I was closing at least maybe 22 to 30 loans a month, man.
That's crazy.
By myself, dude.
That's crazy. So you like Kanye West. You got Jay-Z over here and Dame Dash, and you trying to figure out which way you going to go.
Yep. And you love both these guys.
Yeah. You don't want to sour the relationship with either, but you got to make a decision.
You got to make a decision.
So what was your decision?
So I ended up going with my mother-in-law, and she started a company called New Hope Mortgage. And she offered me a partnership role, in that particular company.
Okay.
I probably could have made more money staying with the larger company, but it was a lot of turmoil, and I don't know, how it was going to go or whatnot. So I ended up going with the smaller route at New Hope Mortgage.
And let me say this, you also chose family.
Yeah.
And family and business often don't mix.
It's a little. It could be. It could be really tricky, man.
Yeah, because the personal and emotional. Listen, we're talking about money, right?
Right.
And numbers. So you would think that when you're talking about money and numbers, we're very mathematical, and this means this. But the moment you put family in it, it gets tricky.
It gets tricky, man. It's real delicate.
I applaud you for taking that route, because I'm pretty sure you were aware of that before you made that decision.
Yeah. And then on top of that, my whole name and brand was associated with the other company, and when you branch out, it's different, and it's uncharted territory, a lot of turmoil in the market. So it was a really, really, really crazy time.
Right. Understood.
So we branch out. I'm now trying to train other loan officers to come in, but like I said, the market is still going crazy. It's still bottoming out, So my mother-in-law ended up, she was just done with the business, just from being at that company and been in the business for so long. Still has some other matters going on with the other company. She was just burnt out.
Right.
So now she's ready to go.
Right.
So now she offers me a position. Hey, you want to buy the rest of this company out? You just pay me later. I'm done with it.
Right.
Washed her hands with it, walked away. So now here I am, still trying to figure it out during the worst possible time to start a mortgage company.
Yeah.
Right. The worst absolute possible time to start a mortgage company in the history of starting a company. Okay.
Right.
I'm by myself. I'm still trying to, close loans to sustain the volume to pay, these bills and utilities. You still got overhead or whatnot.
Are you the only employee there?
As right now, no. But back then, it was just me and my wife.
Got it.
And she was also burnt out.
Got it.
And then, like I said, I was still having a lot of volume because I've been doing it for so long, and realtors were still calling me, get this person approved, that person approved. So my volume never really dipped. It's just that it got so hard to get people approved during that time. My hands were tied. Right. And also, too, the people that I did get approved, they're not buying $150,000 homes like they were. Now they're buying homes for like $60 and $70 and $90,000.
Right.
So my commissions are getting cut in half just on the sales price only.
Mm-hmm. And it's taking you the same amount of work to get them through.
Triple amount of work. Very, very hard, you know. So it got tough. She ended up getting out of the business, right? So now it's just me. My wife ended up going to, she wanted to go back to school to get something, do something totally away from mortgages and real estate. So I don't want anything to do with it that's tied to the economy, the market, or anything. So I pulled some strings, and we were able to get her into med school, right?
Okay.
So she finished up. She's an MD now.
Mm-hmm.
But that was pretty tough, you know, getting her through med school with 3 kids during the worst, you know, financial collapse in history, right?
Yeah.
So it was really, really tough. And then I'm still trying to manage the business. I have other loan officers that's working for me, but they're getting discouraged. So they're kind of in the door, out the door. You know, you spend so many weeks training people, and they just can't stick with it, you know. So it was one of those things where we just went around in circles for a long time. But I just kind of toughed it out, you know. I just kept doing more, try to add more realtors to work with, because if they're going to stick in it, they need somebody they can trust. So I just really established that, hey, I'm going to be here no matter what. Call me. We're going to work together. We'll get these people closed out, and eventually this thing's going to get better.
So when it's in a downturn like this, at what point do you stabilize mentally and say, I know this isn't going exactly to plan, but at some point this thing is going to level out and it's going to turn around and we're going to be okay? How many days can you say you questioned that and said, damn, this was a horrible idea?
Man, you know what? Before the collapse, I mean, you're talking to a guy that was like 20-something years old. I mean, I'm in the clubs. Me and my wife, we're partying with like rappers, you know, because I just had money like that. Mm-hmm. You know, we had 3 BMWs. You know, man, I'm literally, you know, in Club Vision with like T.I. and Young Thug. I mean, not Young Thug, but Slim Thug, these older guys, you know.
Yeah.
Had no business spending the kind of money that I was spending with these guys, right?
Right.
If I had saved all that money, I could have rolled it out until it got better.
Yeah, you've been more comfortable.
I would have been, yep, and I could have just rolled it out, you know. But we just you're young, you don't really know, so I just wasn't saving like I was supposed to. You know?
It's called. There's a term for it. It's called lifestyle inflation.
Yep.
It's called lifestyle inflation. Basically, when you begin to make a certain amount of money, you begin to spend a certain amount of money because in your mind you've got it.
Yep.
Right, and you never take into consideration that things could turn around in a minute.
Yep. Now my boss told me to say, don't do this, don't buy that car, you don't need to do this. But I just thought he was hating. I said, man, don't worry about it, man. I'm Andy Gobin, man. I'm gonna do it. Right. And I did.
Right. You know who you talking to?
Yeah,
it's
man.
me.
And it was just one of those things, man. And you know, if I did like I was supposed to, not only could I have rolled it out, I could have bought so many houses because those houses were selling for $15,000, $20,000, you know, $30,000, and I would just have had cash to buy at least 10 or 15 homes.
Right.
And those same homes now that I saw selling for $15,000 and $30,000 are selling for like $250,000, sometimes $400,000.
Right
now to this day, you know. So I think about that part.
Like you say, you don't know what you don't know.
I think about that every single
man.
Listen,
I bet you probably
time,
chuckle
man.
when you look at some of the prices, some of these same houses. Like, are you kidding me?
Man, I'm telling you, man. So, but when you're in it, you just really hope for the best because that was uncharted territory for everybody. You know, I mean, everything just went wrong.
So when does it turn around? When do you see the light at the end of the tunnel?
You know, I want to say, and I hate to keep showing my age, but around Obama's maybe second year or third year, you start to see things start getting a little bit better. It took a little while, you know what I mean? But a lot of programs kind of rolled out to kind of help incentivize home ownership. There were like a lot of first-time buyer programs started coming out onto the market. We even had tax credits during that time. They started to lower the credit score criteria to get approved. So they really did a lot to restabilize or pump back money into the housing industry.
Got it.
So there are a lot of programs that now I have these programs in my back pocket. Let's see if we can make something happen.
But it's crazy because there was a lot of backlash by a lot of these programs because people were feeling like these programs they were putting in place were part of the reason we got here in the first place. You approving folks that probably shouldn't be approved when the reality is, you know, it was just folks that just didn't meet that very strict criteria that if you just gave them an opportunity, they'd be awesome homeowners.
Yeah, well,
you know,
and the thing about those programs is that, you know, for me, just being a loan officer, I'll say this. Every loan program is a good loan program. It's just that every loan program is not a good program for everybody.
Right.
So what might be good for this guy might not be good for you.
Mm-hmm.
So what happened, part of the reason that caused the meltdown was that, like you said, a lot of people, you know, got loans that shouldn't have loans. So you had a lot of no income verification loans back then, right? Mm-hmm. So you would have people that would just fill out an application. They say they make, you know, $7,000 a month. They'll buy a house that they totally can't afford. Whether they come up with a down payment or not, they still got in that house.
So let me ask you this. So back up, because you're talking to an audience out here that may not understand what that is. So is a no income loan the same as a no doc loan?
Correct. It's just about the same. So a no income loan basically means that we do not verify income. Mm-hmm. So that means we verify you have a job and that you do work somewhere. We just don't verify how much.
Okay, so I thought if it was a no doc loan, it was a situation where you don't have to show us your tax returns, but you got to show us 6 months of bank statements showing that you got some cash coming in. That's
how
true?
It is now. But back then, what part of before the crash, it was nothing.
Are you kidding me?
It's nothing.
See, that's crazy because and I'll speak to me personally. I've worked for myself my entire adult life, and I've always made money, but I wasn't making money and filing taxes in a way where the government or I wouldn't qualify for a FHA loan. It's just on paper. Right. It's just not a good idea to lend to you. And you telling me I could have went to the bank anyway and said, I ain't got no documents, give me a loan.
Well, back then you could have.
That's what I'm saying.
And that's who those loans were designed for. Because you're self-employed, you can afford to pay a higher interest rate. You know, you're just not doing everything you need to on those tax returns like a W-2 person is doing. And you know what you can afford because you know you're a business guy.
Right.
So you know your budget better than, you know, just the average first-time buyer that just never ran a business, never done any budget, anything like that.
Right.
So what happens, the wrong people got those loans that were designed for somebody like you.
Right. And also, too, like, you got a decision to make. So, like you said, if you go in and it's a no-doc loan, and this is applicable now for the viewers watching. If you say, okay, I'm going to do a no-doc loan and, you know, they're asking, all right, well, it's going to be, let's say your mortgage is $400 more than it would be had you had your taxes, right?
Right.
But on the flip side of that, the taxes got to reflect 2 years, let's say 1 year. Mm-hmm. But look at the tax liability that you've paid the IRS. Now, if that amount is, say, $30,000 for the last 24 months, the question is, how long are you keeping this house? Because if you're not keeping that house that long, which is more, the $30,000 that you're paying more, or
exactly
over time? So that's a question you got to ask yourself.
That's something you have to ask yourself every single time. Yep. And when I get self-employed people, even to this day right now, we don't have the no-doc loans like we used to. So back to something you said, now we do verify income. So, but it's a different verification of income. So we will do a 6-month bank statement, a 12-month bank statement. We'll take 12 months of, let's say you're a hairstylist. We'll take 12 months of your business bank statements, and we'll use 65% of that sometimes as income. We the other 40 or 35% that we don't use is considered expense ratio. So 65% of those gross deposits is used as qualifying income. So as of right now, there's really no doc loans that are on the market right now.
Got it.
There is some type of income verification on every single loan that closes.
So you said 65% of the gross deposits.
Is income.
Right. So all of you guys out there are cutting hair, you got a service where you doing landscaping or whatever.
Oh man, you know.
But you're in an industry where you're getting a lot of cash in hand. Please make sure that you are putting that money in the account so that there is a paper trail. Because, the bank doesn't want to hear you made XYZ. They need to see it on paper.
They need to see it. Even if it goes to Cash App or whatever, take it from Cash App, put it into the bank.
Yep. And a lot of people, they won't do that. They'll just say, I got the money. The bank don't care. Like, listen, man, I get it. We don't trust the banks a lot of times, man, but take that money under your mattress and put it in a bank account, man.
Put it in the account.
Yeah.
Put it in the account.
No. So let me ask you this. I come to you and I understand every profile is different, right? I got 600 credit score, and what are some? And now I'm asking you from a credit standpoint. What are some things that I can do right away to improve my score? I understand that there's apps out there that you can use to. They say use this app today and boost your score 50 points. What are some tricks? And I hate to use the word hack, but what are some things that we can do to get our credit scores at a place where we're more desirable to a lender?
Gotcha. Okay. Well, first thing, talking about apps, the number one app that most people go to is Credit Karma. All right. Problem with Credit Karma is that they use a different scoring module or rating module than most lenders like car dealerships or mortgage companies use. So it's not uncommon for somebody to come to me and say, hey, I checked my credit score on Credit Karma. My credit score is a 700. They go to a car dealership or they come to see me, and that thing might be a 600.
Yeah.
Usually
it's not the same.
Yeah, it's not the same, right? So what I tell a lot of people, it's really no just true hack to it. You know, you just have to have a mixture of credit. You want to have a little bit of installment debt and a little bit of revolving debt. And then on your revolving debt, you want to try to keep your utilization down to about 30% of whatever your credit limit is. So for an example, if you have, one or two credit cards with $1,000 credit limit, I tell people if you go over 30%, try to pay it down as quickly as possible. Don't pay it to zero because you need that repetitive payment history to report with the credit bureaus. But try to keep it around about 30%, and it just keeps you active in the eyes of the credit bureaus.
Got it.
Next thing you want to do is limit inquiries. You don't want to have a whole lot of people looking at your credit each and every month. You go to, BrandSmart, they kind of entice you with a card. If you can afford it and just pay it, without getting that card, and you don't need to build your credit, don't let BrandSmart, pull that credit because that is going to be an inquiry. You go to a car dealership to buy a car, try to tell them, say, hey, don't shop my credit with 30 different banks. Try to limit it 2 or 3. Inquiries hurt a whole lot.
Yeah. And speaking on the inquiries real quick, I tell people all the time, man, if there's a car out there that you want, secure the money for the car before you get to the dealership. Yep. Because dealership don't care.
Dealership don't care.
They send you the finance person, and the finance person is going to shop your credit with everybody they do business with. Yep. When you can go to Navy Federal or whoever it is that you bank with and say, hey, I need this car right here. Right. And, they're going to look at it one time and it's going to be a yay or nay.
One time, a yay or nay.
And you won and done.
Yep. That's it.
So a lot of people, they just, and not to mention, it's incentives at the dealership to tack on this, and this on that loan.
It is. Yep. It is. And then the third thing I tell a lot of people is just watch your mail. When you get stuff, you never know what may come back. Let's say you go to the hospital, for whatever issue you may go to the hospital for, right? Your insurance company is supposed to pay, a portion of the hospital bill if you have insurance. If you don't have insurance, they'll still treat you. Then they'll send something to your house, grandma's house, whatever address you give them. You don't pay that bill, next thing you know, there's a medical collection. And those are like one of the top things that we see on people's credit reports are medical collections. And a lot of times when I go over them with people, they never know it even existed. Right. Now, when it comes to getting somebody approved, we don't really put a whole lot of weight into medical collections because we already know as lender, there's always a disparity on what the insurance was supposed to pay, what you were supposed to pay, or did they overcharge you, whatever the case may be.
Yeah.
But it does hurt your score.
Right.
So we don't really look at medical debt, but the credit bureaus do, and it does hurt your score. There is some legislation, I think, on the table now to have it to where like medical reporting doesn't weigh as much on the credit reports going forward.
I know they passed something to where your bill has to be itemized now.
For medical bill?
Yep. Okay. It used to be with the medical bills, they could say, hey, you owe XYZ. But now they have to itemize it and say this was this, and this. And allegedly 90% of the time it's inaccurate.
Yeah. Well, that'll help out a whole lot. Yeah. Yep. Then the fourth and final thing is just pay everything on time. If you think I tell people, like, if you need to borrow money to not have a 30-day late on your credit report, do that and then just pay that money back. But whatever you do, pay everything on time that hits your credit report. Yeah. Even if it's $10 or $100, just pay that on time. Yeah. Those 30-day lates just will eat up your credit report like termite in woods.
Man, I'm one of those guys that I got so much going on in life that sometimes I just miss a payment that's supposed to come out. So, and then you be so pissed that you missed a payment that was $15. Yeah. But it don't matter how much it was, it's still late.
It's still late.
So if you're busy and you can't monitor it like that, put it on auto pay just to make sure, as a precautionary measure to make sure that it's getting taken out every month. And I'm preaching to myself right now, because that was something I told myself. There's a couple of accounts I need to put on auto pay because I always forget about them. But
yeah, man, it'll hurt you. Hurt you.
Yep.
So
cool. So, you got your company going, and you out here, and you're helping folks to get to the finish line. And at some point, because you're successful in what you do, you've made a lot of money in this field. At what point does it no longer become about the money and about the customer?
Yeah, for me, it was one of those things where, you want to help as many people, as you can help, right?
Right.
And you look at some people that come to me, Jeremy, I'll tell you, one thing that sticks with me a lot, when I get a first-time home buyer, and they may be 65 years old, right? That person comes to me and they'll say, hey, you know what? I've never bought a home before. I'm 65. They're still working, right? And they just have not really saved up a whole lot. They've put their kids through school. Some people may be taking care of grandkids or anything like that. And you say, you know what? I want to help this person reach their goal, because they don't really have a whole lot of goals left, or a lot of boxes that they can check off, right?
Right.
So for me, and I'm talking about hard-working people, and you think about it, when you're 65 years old, the average person starts working, let's say a real job, let's say 25 years old. So you're talking 40 years of work, 4 decades of work, right? And they come down to this point where they've rented for 40 years, So for me, that's part of my why now, just to help that person, or to help the person that wants an opportunity that, doesn't know what to do, or like some of the younger people that get out of college, they start working, and they want to just say, I'm going to rent for 12 months, but after that, I want to go straight into home ownership. That becomes my why now. Before it was about the money, but now it's about helping these people reach their goals of home ownership. And also, too, with new realtors that get into the business, say, hey, I want to be a real estate agent. I want to sell houses. I want to try to do this to help my family out. I want to help that realtor close as many deals as they can close, because now they're providing opportunity for their family.
Understood.
And it's also helping these families get into these homes too.
Right.
So for me, that's becomes my why, is seeing these people take pictures at closings and have them cookouts in their backyards and
their family over and everything.
Stuff like that, man. So it really stuck with me a lot, man. I've seen that so many times, man. People that are just, and I hate to say so old or whatnot, but we're talking about our elders, that have never owned anything.
Yeah. I mean,
I help those guys get into something, man. It's huge.
I mean, if we gonna be real, like, my mom has been in the same apartment for 30 years.
Get out of here, man.
30 years, and she's still there in Chicago.
Wow.
And she has no desire to purchase a home. And I even asked her, I said, hey, Mom, how about, because she don't want a house. She don't want to have all that responsibility. I said, how about I get you a condo somewhere nearby where you are? I don't stay where I'm at. So I get it. And that bothers me, but she's happy. That's all that matters. Yeah. So somebody that already owns a home, right, and they're looking to invest, not necessarily in a property to sell, but they want to get them some residual income on a rental property. Yeah. Right. So my question is this. You don't have another job per se. You've got the same job that you got when you got qualified for the first loan.
Right.
So how do we go for house number 2? How does that work?
Yeah. All right. That's actually a really good question. Now we have some programs on the market called DSCR loans.
DSCR.
Yep.
Okay.
And that stands for a debt service coverage ratio loan.
Okay.
So what this means is that if you want to buy an investment property, you want to do a short-term rental like an Airbnb, you want to do a long-term rental, just with like a standard tenant or something like that, you can buy an investment property and don't have to qualify for that property. What'll happen is, well, income-wise, you don't have to qualify. But what happens is the appraiser goes out to their property. He's going to do a rental analysis on that property. And as long as that rental payment or potential rental payment can cover that mortgage payment with a cushion of at least 10% to 25%, then you can buy that home, and we won't get your paycheck stub, W-2s, or anything like that. Basically, the property will cover itself with a cushion of about 10 to 25%.
Got it.
You do have to have about a 660 credit score. Down payment on that loan can kind of start at like 15% and go up from there. But your standard investment loan, you are looking at a higher down payment than on an occupied deal. But it is a good way for first-time buyers, first-time investors to get into the real estate industry.
I've never heard of that program, and
Yeah, man.
that's amazing. That's amazing. So essentially, what you're saying is, if you got the credit score and you can cough up 15% down on that house, and you said the rent potential exceeds the mortgage payment.
Yep, by at least 10 to 25%. Yeah, you can buy that property.
That's amazing. Okay, so let's shelf that program for a second. What's my other option?
Other option, you have to qualify for that particular property plus your current home, and then you still have your standard down payment.
Got it. So that's what I was getting to, because that's how I always thought I thought that was the only way. So you got your first property, so you need to be able to qualify for the property
home
that you're in, your primary residence, and another one.
And another, yep.
Jeez.
Yep. But now these programs are kind of designed to help investors to buy property.
Yeah.
So they're really, really good. We've been doing a lot of them.
Yeah. No, that's amazing, man. And we're going to talk more off camera about that.
Yeah.
And maybe we can get you back again to just dive a little bit deeper into that.
Yeah, I just financed one for a guy in Florida. He's doing an Airbnb with these properties, and he's doing pretty well with them.
Let me ask you this. Does that program work for a multifamily home?
You can do up to a 4-unit. Yeah, you can do up to a 4-unit.
So I would like to think that most 4 units would qualify for that anyways. Cause
you'll be surprised. Sometimes they don't, because some of your multifamilies, the taxes are a little bit higher. Your insurance policy is a little bit higher. So it's not as easy as you think it is sometimes. Yeah. So sometimes it can kind of vary a little bit.
Yeah.
And it also too depends on the area.
Right.
So it's a few factors go into it. So it's not as gravy as you think it is. So it is a little tricky to it.
No, I get it, and I need to become more knowledgeable in that space, man. Shout out to my brother. My brother literally just closed on 5 houses on yesterday.
Oh man, congratulations to him, man.
Yeah, it was a realtor that knew that they had 5 houses they were trying to get out of it. They were tired of managing the properties, and the upside of them, 4 of the 5 properties already had renters in them.
Occupied. Yeah, that's good.
Yeah,
they were in Georgia?
No, this was in Louisiana.
Okay, cool.
Yeah. So he's like, bro, he sent me the listings of the 5 houses. I'm like, he said, they all got renters in them. I said, okay, cool. So he just closed on, and it was a situation where he knew a realtor that knew about the deal. And they called him, because I don't even think it had hit the market yet.
Gotcha. Okay.
Called my brother and said, hey, man, I got an investment for you. And he says, man, what do I sign?
Yeah.
So, shout out to him.
Man, it's good stuff.
Man. So
generational wealth, man.
Yeah, and that's how you start.
Yep.
That's how you start, because one thing about it, they ain't building no more land.
No.
That ain't happening.
No.
That ain't happening.
Not anytime soon, anyway.
Yeah. So let me ask you this. How many people working for your company right now?
It's probably about 8 of us total, right now.
Yeah.
With about, out of the 8, maybe 6 are like loan officers, and the other 2 are just staff members.
Got you. So, and another question. What states are you licensed to do business?
Yep. Georgia, Louisiana, and Florida, and we're working on Alabama.
Okay.
So we're going to try to stick to the immediate southeast area.
Yeah.
The only thing about Louisiana, it's a real tough market in Louisiana. Certain parts, the flood insurance, man, is just horrendous, man. It is just horrendous. So that's one of the challenges in Louisiana with financing homes. Man, sometimes the flood insurance can be just as much as the mortgage payment sometimes.
Yeah, I bet.
Depending on where you are in Louisiana.
Gotcha.
So it's real tough.
We're at the Entrepreneur Network, so it's only right that we take a more deeper dive and lean more into that as far as the do's and don'ts as entrepreneurs when it comes down to our credit and investing and getting a mortgage. And not even just that, but what if I'm in a situation where I'm trying to buy a building for said business.
Gotcha.
Right? So walk us through the differences between like personal and business and some things that we need to look out for.
Gotcha. Okay. All right. So in the lending industry, entrepreneurs are like some of the most toughest people to finance. One, because like we spoke about earlier, tax returns, right? So I know entrepreneurs, which you do too, make a boatload of money, right? But when you file your tax returns, your average tax return for an entrepreneur is designed in a way to not owe the IRS a boatload of money.
Right.
And I get it. Who wants to pay Uncle Sam? Nobody, right?
Right.
So what happens is you either got 2 choices, right? One, you either, like you said, we find out, is it better to pay the IRS and file a boatload of profit on our tax returns, or do we do some of the non-traditional loan programs when it comes to finance, right? And, with the tax returns with entrepreneurs, even CPAs, they're trained to try to save you as much money, as possible. And they're just not really getting you to claim a whole lot, because on a tax return for an entrepreneur, we look at the net income, not the gross.
Right.
A lot of entrepreneurs think that, hey, I showed $100,000, I wrote off $80,000 in expenses, my net is 20, but you see my $100,000 here, so you see where I made 100. But with underwriting, they don't know if you really had $80,000 in expenses and your true profit is the 20. We can't tell how much of that 80,000 is fluff or not. So they have to use that as like they take that away from your income.
Right.
And then what's left over is what you qualify with.
Right.
And 90% of the time, it doesn't matter if, you're doing hair, you're doing landscaping or whatever, 90% of the time, on most entrepreneurs' tax returns, it's just not enough money on that bottom line number to qualify.
Right.
So
Understood.
That puts us into a position to where now we look at these non-traditional documents, right? We go off those bank statements. On the business bank statements, we look at a certain percentage of the gross deposits, then that's the income. We also have another program where we can use a profit and loss statement. And whatever that profit and loss statement, as long as it's prepared by a CPA, we'll use that as the qualifying income.
But wouldn't the profit and loss statement reflect the tax returns?
Not a lot of times. A lot of times, you create your own profit and loss when it's time to buy. So your profit and loss for this year might not look like the profit and loss from last year when you did all those write-offs that you probably shouldn't have done.
Right.
Right. And I tell a lot of people, when it comes to those tax returns, man, you want to be really careful, because it's okay to write everything off as long as you don't get audited and you can't document all those write-offs, because now the IRS is going to add back whatever you can't document on those write-offs. They add that back as income, and now you owe a certain percentage of that as taxable income, and now you owe the IRS a liability.
Let me ask you this. You've been doing this a while. And I understand all situations are different, but what's the likelihood that you'll get audited?
Man, you know what? It's kind of funny, man. I've been audited several times by the IRS, right?
Okay.
And they went through. I've actually had my accounts levied. So one day I woke up, go to my account. I had $20,000-$30,000 just in my little checking account or whatnot. And now I look up and it's like down to like $1,500. So I'm like, what in the world is going on? So I look on the statement or whatnot, and it says this word that I've never seen before, L-E-V-Y. I'm like, man, what is Levi? What's going on? What's going on? So I called Bank of America. They're trying to look into it, and they told me it was a levy. I was like, who levied me? What's going on with that? And it was the IRS. So I had been audited. They went through, and I guess they added back some income or whatnot. And I didn't know they even had the power to do this, where they can put a levy on your checking account or savings account or any account that you have for whatever potential payment that you owe. So now I had to call the IRS, and during that time, I ended up actually building up some rapport with the IRS, because I found out that as long as you communicate with them, whether it's a small payment or whatever the case may be, usually they're actually pretty decent to work with. And it's not like I'm an advocate for the IRS or anything like that, but I've owed up to maybe $60,000 to the IRS or more, right? And I think on the $60,000 when I owed them that 1 year, my payment arrangement or installment agreement, as they call it, was like $110 a month. And they drafted it out each month. And then when I had a good month, I pay a little bit more. When I had a bad month, I made the minimal payment, and I eventually got it down. But I never had any issue with them since that point. And any other time that I've owed the IRS, I reached out to them, say, hey, this is the deal. This is how much I can afford to pay. And each and every single time, even if it's $50, $75, I have customers now that still would call. I say, hey, don't be afraid, call them. I tell them, hey, you're buying a house, you got 3 kids, this is your income. And every single time they send over an installment agreement, $50. Just did one for a tattoo artist, self-employed, filed his taxes, entrepreneur, has a tattoo shop. He was just deathly afraid. I said, dude, don't do this other program. Just file 2 years of taxes, set up an installment agreement. At least that way you have your tax returns on file. You can buy whatever you want to buy. You owe the IRS maybe $10,000 or $15,000, and that's over a 2-year period. So if you've made like 4 times, like you're still like coming up pretty good, right?
Right.
Set up an installment agreement or whatever that amount was. It was like $75. We stick that into his DTI. He's in his house right now, And this was just like maybe 90 days ago.
Sweet.
He said, man, I know they're easy to deal with like that. I said, dude, let's just call them and just tell them, And sure enough, they sent over the installment agreement.
Yeah.
Set it up on automatic draft, and he's good to IRS from here on out.
Sweet.
Now, what he does with his tax returns going forward, it's up to him. But he did those 2 years to qualify, put his tax debt into an installment agreement. It's good to go.
Sweet.
Yeah.
All right. So look, man, what I got from that, and you're talking to me in a lot of ways because I'm afraid of the IRS. I'm serious, man. I gotta.
It's when you ignore them, you hide from them, don't respond to the emails or letters. Yeah. That's when it can, But if you call them and say, hey, man, this is what I made. I mean, they can't take what you don't have.
Yeah. I don't know where my partner's son got this from. I went to their house and he jumped, little Jermaine. He jumped out the corner. He said, taxes. I said, boy, what are you doing? He says, everybody's afraid of taxes. I said, what? What do you know about taxes? You're 10. Yeah. You know what I'm saying? Funny, man. So he heard that somewhere, Yeah. But no, to your point, like even myself, because now, and anybody that's in business knows this, before the Patriot Act, what would happen was any of your transactions that took place electronically, whether it was Square or whatever your payment processor was, it was on you to report that to the IRS.
Correct, yeah.
After the Patriot Act, no. Whoever took that money on your behalf reports it to the IRS. And then they send you a letter, hey, Mr. Winters, we told the IRS that we processed this for you. And it automatically goes on your account.
Yep.
So you can't run from that.
Cannot run from it.
You can't. So if you know that, then listen to the man. Be willing to have an open dialogue with them. And I'm kind of talking to myself right now. When I watch this back, I'm going to look at myself and say, listen, have an open dialogue with these people.
Yeah. And I've seen payment or installment agreements as little as $25 a month.
Yeah.
Yeah, I know truck drivers that I don't think they're ever going to pay off the IRS, but they're not liens. The IRS haven't levied any accounts. They're not putting any liens on any property or any tangible goods. He owes, and these are people that I personally finance, right? Truck drivers make a boatload of money, man. And he owes hundreds of thousands of dollars to the IRS. And he pays like $75 or $80 a month. And he says, I'm going to owe this debt to the day I die. And as long as I pay them, they don't bother me. Take the money out, and it's just no different from Netflix or whoever. And and he's just okay with owing that money.
Wow, that's amazing.
Yeah, man. This is stuff that I actually see.
Yeah.
And I see the installment agreements because I have to have it, because when I see that kind of tax liability, we have to have something in writing saying, hey, I want to make sure you're paying these guys because we don't need an IRS lien to pop up on this house we're about to finance. So as long as you have that installment agreement,
got it.
You're good.
Let me ask you this. So, boom. Business, personal. What are some of the things to look for if this is an investment that I'm looking to do for said business versus my personal?
Gotcha. You mean as far as like if you want to buy a property for the business or like?
Correct.
Gotcha. Now with that, most of your down payments, if you do something business-wise, starts at like 25 to about 35% for a down payment. So let's say like you want to buy a building or a restaurant, whatever the case may be. At a 35% down payment. We do a commercial loan. Those rates are a little bit higher. And sometimes the income qualifications can be a little bit more forgiving because they know that you may not be reaching your full income potential because what you are making as a caterer, catering out of your truck or just doing private events might not be the same income you're going to make at this restaurant.
Right.
So now we'll look at the overall gross income or earnings potential for that particular restaurant. What it could do, or if you can get financial statements from the previous owner on what that restaurant was doing, that income can also be taken into consideration to help qualify that person for that building.
Wow. I never knew that.
Yeah.
Because you could be a horrible business owner, but you telling me that they can use the previous businesses' reports as something to validate the loan.
Validate the loan, yep. Same thing with an apartment building. Anytime you finance I'm talking about like a commercial apartment building, 200-300 unit apartment complex, you have to get those rent rolls from the current owner of those properties to show this is what these properties generate. Right?
Historically, this is what we're doing.
Correct. And that income is used to qualify that person for that apartment complex.
Understood.
I don't do a lot of commercial lending because that's not just my area of
expertise.
Direct expertise.
Understood.
Yeah. But I do them every now and again for particular people.
I can assure you know more than everybody in this room.
But we do them, but just on a case by case scenario. But we do know a lot. But yeah, it's a lot of programs that are out there to help people acquire property for their businesses.
Okay, so speaking of programs, I know I said we get you back on. We can talk about this later, but the program that you mentioned earlier, I'd like to speak on that again, man.
Yeah.
If you could, what was the name of it again?
It's called DSCR.
DSCR.
Yeah, it's a debt service coverage ratio.
Got it.
Yep. So as long as that debt is serviced by that coverage ratio that the property generates, you don't have to qualify for your income. So like I said, it's a really, really, really good program. It's not for an owner-occupied transaction. It is for investment purposes only, right? You can use short-term rentals. That's your Airbnb, vacation rental by owner. It's a really, really good program. The rates aren't the best. You may be talking about maybe an 8.5%, 9% rate, but it's still not bad for the type of loan that it is.
Right.
But it does kind of take some of the hindrance on the tax returns, pay stubs, and qualifying for multiple properties. Because somebody that owns, let's say, 10 properties, is hard to qualify based on what you make, income-wise for 10 properties.
Right.
So you have to have these programs in place that allow people to still expand their real estate portfolio without having to qualify for each individual property in like a lump sum basis,
Understood. So, all right, let's say, and we've got property number 2 under our belt. Can you use that program again for 3, 4,
For 3,
5?
Yep. I think you can finance up to 15 properties. Yep. As long as you got.
How long has this program been going on?
This has been out for about maybe 24 months, 2 years.
Okay, so it's essentially you've got to do your homework and figure out which properties make the best sense for this program.
Yeah, and a lot of times your realtor can do a rental analysis for you. That's something they can do before, you can go out and start negotiating on that property. So a lot of times they can look that up and see what their property generates, or the potential that it could generate.
Got it. All right, let me ask you this. Do you have any CPAs on staff?
Not on staff, but I do have relationships with several CPAs that are really, really good. And a lot of my CPAs that we deal with do specialize with working with entrepreneurs. Yeah.
Got it. Okay, so listen, man, if you're an entrepreneur in the Florida, Georgia, Louisiana area, and soon to be Alabama, you need to reach out to this man and his team. He's got a wealth of knowledge and resources that can help you guys in your endeavors in home ownership and, even expanding over into business from a rental property standpoint. So, man, I appreciate you, man.
I appreciate you having me out.
No, man. Hey, man, thank you, man. I love to come back over to the house, man. And,
absolutely, man.
Get on some pool or something, man. Listen, this man I've never been to someone's house that actually hunts, right? So when you come into his house, you know what I'm saying? He's got the deer head on the wall. He's got the giant fish.
Yeah.
The fish got that look like I almost got away. You know what I'm saying? Like I appreciate it. And I'm like in awe every time I come over there.
I appreciate that, man.
Yeah, man. Hey, we love what we love, man.
Hey, it's one of my passions, man. Anytime I can get away from the desk and get outside, man, get some fresh air, man.
Yeah.
Yeah, that's what I do, man.
Man, that's dope, man. For me,
yeah.
If you could just get a giant mosquito and just put it in a jar for me, I'd feel proud. I hate mosquitoes, man. That's one of the things, man. I love outside,
right?
But if you could just eliminate the mosquito species, I'd be a much happier person. And I understand that they have their position and the hierarchy of life and all of that stuff, man. But just can't we figure out a way to kill all mosquitoes? Yeah. This just went left, man. I'm sorry. I hate them, yeah. Man. But hey, man, tell everybody how they can find you.
Yeah, man. Andy Gobin, New Star Mortgage, or newstarmortgage.com. You can follow me on Instagram at ATL_home loans. Or just Google Andy Gobin. I'll pop right up.
Right on, man.
Yeah, man.
It's Andy Gobin. Yeah. You know who I am, baby. Right on, man. Hey, this has been the Entrepreneur Network. Sitting there with my man, Andy Gobin today, man. And tap in, follow him. And if you need any more real estate advice, he already told you how to get in contact with him. And we are out. Phew.
If you can get it out the mud, then you can't manifest it. Bet on yourself.